Good morning. It's great to be here with you all today. I want to start by addressing the reality of the market today. We've seen the largest jump to default event on one of the largest lending protocols within the space today. And as you would expect, the market's reaction was naturally one of panic. We saw rapid withdrawals, we saw utilization rates spike, and we saw a lot of anxiety around contagion. But the core thesis of my talk today is that we don't need to panic about this. These events there's going to be more credit stress to come, and I'm here to tell you today why that's actually a good thing. So defaults are far from the end of on-chain credit. There we go. Anyway, we'll keep rolling. Every time a complex financial system breaks, it exposes weaknesses that were previously just theoretical. A default tests the plumbing, and it ensures that you have in place the structural integrity to handle risk in real scenarios, not just when it's modeled theoretically on a spreadsheet. If you think about the traditional financial system, it didn't emerge fully formed. It was the product of centuries of crises, defaults, and stress events. And what happened is that every time one of these events happened, a new solution was born that strengthened the system. What we're watching today is that the on-chain credit system is growing up in real time. This friction is a necessary part of a highly productive process. Without it, we would be building a house of cards, but with it, we're building the infrastructure to handle hundreds of billions of dollars of credit markets. But let's look at what recent events have exposed. They've pointed out a particular issue with how we handle credit on-chain, a critical flaw, which is who makes the decisions when credit events happen. So, right now, DAOs are the ones who are making the key decisions around how creditors take losses. But there's a fundamental misalignment of incentives here if you think about it. A DAO is effectively the equity holder in these types of scenarios. Their primary objective is to protect the token price and ensure the health of the protocol treasury. But if you think about it, asking equity holders to vote on what happens to creditors and how they take losses is a fundamental misalignment of incentives that's never going to lead to a fair or efficient outcome for lenders. Imagine a traditional bankruptcy where the equity lenders get to vote on how much of a haircut the senior secured lender were to take. It makes no sense, but we've accepted this dynamic in DeFi because it was the quickest way to launch these products. And we're currently living with the outcomes of that today. So if we take two key examples, so MakerDAO's Black Thursday back in 2020, the liquidation engines temporarily failed, and those who had vaults got liquidated to the tune of around $8 million in damages. However, when it came time to vote on whether to compensate these users, who voted? It was the MKR holders, the equity. And of course, they voted no. Then in 2022, we had the Mango Markets exploit, which was around $110 million. And Mango token holders voted to use the treasury to make whole the depositors. However, they also voted to give a $50 million bug bounty to the attacker and then to waive all legal claims against him. This ended up prioritizing the interests of equity holders over the legal rights and remedies of creditors. To be fair, what we're seeing is the very first steps towards programmatic resolution. So when it comes to Aave's umbrella module, this is meant to be entirely programmatic. It will slash depositors via smart contract when a deficit is detected on Ethereum mainnet. Anyway, I'll keep going. So it replaces human hesitation with deterministic code. But what we're missing is a complete framework. So we don't have a creditor venue. Instead, what we have is governance controlling the parameters, the scope of coverage, and decisions around whether to use the protocol treasury to recover losses. However, critically, DAOs are still deciding the harder questions. They decide whether you even formally recognize a default. They decide how to allocate losses across different chains, and they decide whether to recapitalize treasuries. But what we need is a neutral venue. we need to figure out what the on-chain equivalent of a creditors committee is. While platforms like Kleros have existed and tried to do this in a decentralized manner, they've failed to achieve widespread adoption. What we don't have is a place where creditors can come together, assess losses and collateral values, and attempt to execute recoveries without needing to rely on the permission of equity holders or token holders. But there are lessons that we can take from the traditional credit stack. Securitization has solved these problems. None of these are entirely new concepts. We just have to adapt proven structures that we've seen. We already know how to handle defaults. The securitization methodologies have spent decades perfecting tools that help to identify and isolate risks and allocate losses. The best part is we're already actually seeing the beginnings of this being used in DeFi primitives. The first adaptation is the documented waterfall. We need clear, predefined rules for how losses actually get applied. Lenders want to know exactly where they stand in the credit stack and what kind of rights and recourse they have when a default happens. They don't want to be at the whim of a DAO. We've actually already seen this live today. So Royco Dawn recently took Maple's own Syrup USDC product and tranched into a senior and a junior position. So this creates strict smart contract enforced priority of funds. And so if you are in the senior position, you know that the junior tranche is beneath you and they take the first dollar of loss. This is exactly how traditional securitization works. However, it's now executed natively on-chain without the risk of counterparty risk of enforcement. The second innovation we're seeing today is first loss capital. So we need dedicated reserve pools that are going to sit beneath senior lenders and will absorb the first dollars of loss. A great example here is CAP protocol. So they allow operators to borrow from the protocol only if they have secured third-party collateral from restakers. If the operator defaults, the collateral provided by the third parties is slashed and the lenders are made whole. So this is an entirely new model for underwriting. It no longer relies on a centralized credit insurer. Instead, you rely on a decentralized network who is pricing the risk and allocating the first loss capital. The third adaptation is how we actually manage liquidity during a crisis. So in traditional finance, they have triggers for gating and withdrawals. On-chain lending needs similar tools to prevent a scenario where the fastest actors are able to exit whole, while retail depositors are left holding the entirety of the bad debt on-chain. When everyone rushes for the exit, the system breaks. But we're starting to see sophisticated solutions being built here. So first, Maple implemented programmatic queues for Syrup. So we have a liquidity buffer. During normal times, folks were able to redeem near instantly. During times of stress, an orderly queue is formed. Another one that I want to call out is USDAI's queue extractable value. I think this is a very nice and elegant solution where they've tried to use a market mechanism whereby if you want to exit early, you can go into a structured auction process. However, patient capital can wait and follow the amortization schedule. It's actually a pretty neat analog to swing pricing for money market funds. And these are the kind of tools that we need to manage institutional capital at scale. But we've also got to address how protocols operate across multiple chains. In today's world, we see many protocols are deployed across dozens of L1s and L2s, but it's not really clear who takes priority if there's an issue on one of them. So when protocol bad debt occurs on an L2, how are we going to handle this? Are those losses going to be isolated to the specific instance of the protocol on a given L2, or are they going to be borne globally by all instances of the protocol across other chains? Now, this is a new frontier for credit markets. So we're going to actively figure out if L2 depositors are pari passu with L1 depositors, or are they sitting in a different risk tranche to them and subordinate? We need to have clear upfront documentation around this as to whether a protocol is going to have a single global balance sheet or whether it's an isolated instance of franchises on different chains. And finally, wrapping this up. So the on-chain credit market is going to be vastly stronger because of these events and disruptions. The protocols that survive and thrive in the next cycle are going to be the ones who develop clear rules when it comes to the capital stack. They're going to be the ones who combine the best of the tools available in traditional securitization with the speed, the liquidity, and the transparency and global access of on-chain execution. We shouldn't be worried about crises like this. We should actually welcome them as a form of battle testing. It's exactly how we're going to build a resilient financial system that can handle hundreds of billions of dollars of on-chain credit. And so we're not just going to survive crises like this. We're going to thrive off of them and build a more resilient financial system. Thank you.